Good morning. Thank you for standing by, and welcome to Voya's 2016 Outlook for Interest Rates and Spreads. All lines have been placed on mute to prevent any background noise. After the speaker's remarks, there will be a question and answer session. If you would like to ask a question during this time, please press star, then the number 1 on your telephone keypad. If you would like to withdraw your question, press the pound key. I would now like to hand the floor to Christine Hurtsellers, CFA and Chief Investment Officer, Fixed Income for Voya. Thank you, Ms. Hurtsellers, and the floor is yours.
Thank you very much, and welcome everybody. I appreciate you dialing in to this call as we explore where in the world do we go from here in terms of interest rates and spreads. And what we're doing right now as part of the society is we're breaking down some of the forecasting topics of the surveys that everybody had put in December for 2016 into different pieces. And so today we're mainly going to focus on U.S. interest rates and the shape of the curve, but then I do want, just given how the markets have been, how volatile things have been, to talk a little bit about spreads and the credit markets specifically. And I know, again, that wasn't part of all of our survey into our predictions, but I just thought it would be very top of mind for everybody out there. So as we start, I put together a presentation. So hopefully you have that deck in front of you. And if you move to page 2, I just want to point out to everybody, this is what all the members of the CFA Society had said as we put these things together in the fourth quarter of last year. And of course, as you know, a lot has changed. And there's a famous quote, prediction is very difficult, especially if it's about the future. And I would certainly say that for us in this business, right? When you think about where we were, I believe the lowest forecast, or the average forecast for oil was $51 a barrel, and the lowest, most bearish person out there had 35, and look at where we are today. So certainly it's been a crazy market, and you know, just to refrain for everybody, I've looked back and said to myself, well, where were interest rates probably when we were all doing this? It was probably around the time that the Fed was about to tighten for the first time. So it went back to DC15, and the 10-year was 227, and now generally it's been bouncing right around 2%. Oil was a little over $39 a barrel then. It's up today, but you know, it's down in the low 30s right now. And the S&P 500 was 2043. So we've come a long way, and credit spreads, you know, certainly have widened quite a bit as well, with investment grades index going from 166 to 190. So that's where we are. And you know, to kind of start out, I was asked to just share Voya's reason as to what our forecast was for interest rates and the Fed. And we put our call for the 10-year Treasury rate, and you can see the ranges there on the table on slide 2. Our call was for a 2.50 10-year Treasury rate, and for Fed funds to end 2016 at 1%. Now, of course, you know, with everything happening right now, you know, Fed funds, does it end at 0.75, so 2 tightenings as opposed to 3 in this calendar year? Highly likely. However, I think where we are right now, the market's pricing in only 1 move. We're probably at a point where the market's a little bit too pessimistic. But I want to step through the Voya approach for all of you, and then we can, at the end, open it up for some questions around the house view. So, if you will, in the presentation that I sent you, just move forward to slide 3, and there you will see kind of the Voya forecast there. And so generally, again, first bullet, our yield projection is for 250 on the 10-year, and this is based on our GDP outlook of 1.5% for the year, and subcore 2% PCE. So, you know, Voya Investment Management, back in December, we were actually more negative on U.S. GDP growth, and I would say even with the volatile quarter we've had year to date, you know, we're still a little bit below consensus on our GDP forecast, and I'll walk through our methodology. But really, what what we saw and continue to see is that U.S. growth has been slowing really, for quite some time on a year-over-year basis across many different elements you can see. We have some charts there for you on the right in terms of CapEx, shipments, even payroll growth has been slowing. And we've seen real consumption growth has dropped to a 20-month low. And actually, things like capital shipments, real growth is actually negative. So what's happening is that we're seeing slowing momentum, and we believe that growth is going to bottom in the first quarter. And our prediction for growth in the first quarter is actually 0 GDP. So again, we're a little bit more negative than the market. But we do actually, and this is a bit kind of consensus, we do still believe that we are going to have a rebound in the second quarter, a rebound in headline CPI to 1.5, and some stabilization in commodities. And that's really that kind of view that the yield curve is going to steepen, the Fed is going to move slowly, is going to steepen the yield curve and allow long rates to drift up just a bit. So if you would, go ahead and move to the next slide, page 4. And what I want to kind of introduce you to or walk you through is a little bit of how in the world did Voya arrive at these estimates? Why are we a little bit more negative on GDP than many? And so this is sort of some insight into the Voya framework. And so there is a man named Biggs who worked for Deutsche Asset Management who kind of coined the concept of what we call the credit impulse. And conventional econometrics usually looks at stock as opposed to flow, and the credit impulse really sort of gets laser focused on rates of change. And what I want to do is kind of walk you through the example, because when I think about, as an investor, catching turns, thinking about the world, the most important thing that people sometimes miss is the rate of change from where you are. And so let me kind of walk you through this little example, and then I'll go in and show you some of our forecasting based on this idea of what Biggs coined the credit impulse. And so as you can see, we have a chart here. So look at that table, and think about this table as you as an individual. So let's pretend that you have $200,000 of debt. Maybe it's $10,000 credit card, the rest could be student loans and mortgages, but overall you have $200,000 of debt. So when you look at the very first year, what we're calling year 0, you make $100,000, you have $200,000 worth of debt, so you don't borrow anymore, but you spend $100,000. So basically you spend everything you made, and you end the year and you still have the same amount of debt. So the growth in debt is 0. Now, along comes year 2, and maybe that's this year. You're seeing the stock market plunge, things don't feel as good, and you say to yourself, I don't feel quite as confident, about my job or about the economy, and so therefore I'm going to get a little conservative. So I still make $100,000, but I'm actually going to pay down that $200,000 of debt I owe, and I'm going to pay it down by $10,000. How do I do that? Is I eat into my spending. So I pay down by $10,000, my spending goes to $90, and so my credit growth has gone from 200 down to 190. What people will pick up as credit growth is that my credit has gone down by 5% and my spending growth has dropped by 10%. So you decrease spending in order to pay down your credit. So the credit impulse is -10. But in year 2, and this is kind of the subtlety of where things get missed in the Voya way, in year 2, you still make $100,000, you now have $190,000 of debt, and you say, I think I was a little overreactive as far as job instability last year, but I still think it's a good idea to continue to try and pay down my debt. So you take your debt of $190,000 and you decide to pay it down a little bit. But you know what? Not as much, right? You take it from 190 to 185, and so your borrowing, so to speak, goes down a little bit, but your spending goes up. So you spent $90,000 last year, and you now spend $95,000. So that idea that can get missed is that your spending growth actually went up, even though if you just looked at overall debt in the economy, it appears negative. But actually the credit impulse or the change in credit growth as we think about it actually was positive. And so why this is so important is it can really isolate kind of that subtle spending behavior and watching sort of the velocity of how things change. So using that as the paradigm, if you then move on to slide 5, you can see what we're projecting or what we're thinking about as far as why we believe growth is a little bit slower at 1.5 for 2016, and why are we 0 at the first quarter. And really, it's really going back to the future path of credit growth using that framework and really looking at leading indicators there. So what we did on some of these charts is one thing that we find to be one of the more powerful leading indicators of the economy is the Senior Bank Lending Survey that the Federal Reserve does. And so if you look at that chart on the left as an example, this takes a look at the survey of C&I lending to go back to all the banks. The Fed says, are you increasing, are you tightening lending standards, or are you actually making it a little harder to get a loan? And if it's easier to get a loan, like they're loosening it, it's above the 0 line. And if they're making it harder to get a loan, it's below the line. And what we do here is we actually kind of match up and lead the C&I lending survey a little bit. This is by 18 months. Why do we do that? Well, if a bank decides they're going to loosen credit standards, it takes a while to get them through all of their bank branches, into their paperwork and their pricing, and then finally for a human being to actually say, wow, lending standards are easier, therefore let me go into the bank and actually take out a loan. So that's why we have the lag. But you can see there that the fit then, relative to the orange line there, is actually pretty good, right? So you can see tightening and lending standards changing actually correlates very well once you adjust for the actual C&I lending, which is the orange line. And so again, the orange line is where it actually is. The gray line, using our methodology, is actually dipping lower. So that predicts that actually credit growth, banks are tightening up a little bit, that credit growth is going to actually continue to decelerate. And we do, on the right-hand chart, we look at business spending and really all the charts on the page. If you go through the consumer lending book, what we are expecting is a gradual decline, including in retail sales on the lower right-hand chart, a gradual decline in actual spending. So not the rosiest picture, but I think the silver lining, though, in terms of some of the things going on, not only in credit growth, but also just globally, will be that within the U.S., in addition to credit growth slowing, we're also going through some headwinds of, export drag on GDP. Inventory is very high. I think Janet Yellen even referenced inventories in her minutes yesterday. Those are some headwinds that should abate. So in the second half of the year, we think that the drags of inventory correction and strong dollar will be behind us, but not necessarily will we see a rebound in consumer spending. So therefore, we have a pretty muted view of full GDP over the year. Now, if you go on to page 6, just wanted to talk a little bit about labor markets, because this is another element that you hear so much in the market, initial claims and all this focus on tight labor conditions. But if you actually peel back the onion a little bit, you see a little bit different picture of the labor market. And so what we're trying to illustrate to you on this chart is if you look at that top right-hand chart, that actually shows employment, essentially the participation ratios, right, of different subsets of people in the economy. And what you see there is the gray line is the labor participation increase. That's on the percentage there's on the right-hand side of the chart, has been going up very nicely for people with a high school education or less than a high school education. And so what is that? That's most likely, service jobs, retail, restaurants, things like that. So that's been going up, and the orange line is, people with a higher education, and they're really not achieving the same level of growth. So our point really is, when you're looking at really healthy labor participation, a healthy labor market where you're going to see, a little bit more meaningful wage pressure, you really need to see broader participation from some of the higher educated people there. Next thing, I wanted to point out, that second bullet point, it's a newer measure, and you can Google it. I think that the St. Louis Fed actually created what the Fed calls the Fed Labor Market Conditions Index. And that takes into account 19 labor variables as far as the Fed's labor dashboard. So it's a much broader measure of the health of employment. That index peaked in December of 2014. So even using the Fed's measures of labor strength, it's actually decelerating just a bit. And so, finally, if you look at just even aggregate U.S. sales, like what's going on in the general economy, it is just the rate of change there, again, on that right-hand chart, is showing some slowdowns. So net-net, it's a little bit of a gloomier picture as far as the health of the labor market and wage inflation, which is the reason as to why we believe that the Fed at the time was only going to tighten 3 times, and today, even that looks almost, I don't want to say silly, but given all the volatility, 2 times is much more likely. Just very quickly, the inflation outlook, that's on slide 7 on the next page. Why do we still forecast CPI to be 1.5 for the year? Well, really, that is simply because, the commodities complex last year, everyone, declined over 60%. And so as bad as it's been in January, it's really hard to foresee that sort of price decline that pushed CPI lower to really repeat itself. And so if you really look at things like year-over-year changes in gasoline prices, medical expenses, and owner's equivalent rent, we do expect CPI to drift up. And then in terms of the chart, on the top right-hand side, what we have there is all industrial countries, so that's money supply growth, for the world, tracked against U.S. inflation. So you see U.S. CPI year-over-year change there. And so you can see it's a pretty good predictive result. There are some periods of time, such in the financial crisis, where the U.S., was suffering more as an economy than the rest of the world, where it broke apart. But generally, it's a pretty reasonable relationship. And so you can see there that money supply is actually globally getting better despite, the volatility in the markets. And so that's another reason to believe that, once producer prices and dollar kind of stabilize, that we should actually see an uptick in inflation for 2016. On the next slide, just very quickly, and this is a big deal, actually, on page 8, in terms of why our credit spreads actually as wide as they are, and how are they contributing to the economy. So if you look on slide 8, what we're showing here is this basically is a very unusual tightening cycle. And that upper right-hand chart there, that is the Goldman Sachs Financial Conditions Index. And so it's a broad measure. It includes things like dollar, trade-weighted dollar, spreads, and where monetary policy rates are to really sort of gauge, are financial conditions getting worse. And you can see that orange line there is the actual index. And then look at those blue lines. Those blue lines are where were financial conditions at the start of a Fed tightening cycle. And so if you pivot your eyes to the right there, this really is unprecedented, right? That the Federal Reserve has started a hiking scenario, with financial conditions already actually pretty tight. And I think, one thing I do think is, sometimes we fixate too much on the absolute level of rates, right? Again, not thinking enough about the rate of change. But think about what has happened. The Fed's actually already tightened a lot, and this index kind of reflects that. They stopped QE, right? So to the degree anybody felt that QE, and the Fed certainly believed QE was a easing, accommodative policy, they ended that. They had trimmed some of their purchases, right? So they did that. The dollar has appreciated significantly. The increase in the trade-weighted dollar for the U.S. is equivalent to a 100 basis point tightening in the Fed funds rate. So they ended QE, the dollar has appreciated, now they've tightened 25. So don't just think about them as of tightening 25 and going, oh, how pathetic. The market in the U.S. cannot handle only a 25 basis point hike in rates. I get it. However, when you think about the path we've been on, it's much more dramatic than that, and the credit markets are telling you that as well. So going on to slide 9, just another thing that we wanted to point out to you is you hear a lot about secular stagnation. And really this trend is the secular stagnation trend has been going on for a long time. The U.S. GDP has been trending down through modern history, and the current expansion is actually only registering 50% of historical GDP growth, which you would see in an expansion. And what is so worrisome about this, actually, is just the overall level of productivity in the U.S. And when you think about the expansion that we went through in the period of, pre-financial crisis, residential investment actually added 0.5% to GDP, and essentially productivity is GDP, right? What you make is divided by the hours worked, and that's a good proxy for GDP. So the strength in the housing market actually sort of made productivity back over the years actually look better than it really is. And so, now where are we in the U.S., productivity running at 1% pretty much, very, very, very low. And so what happens is when the Federal Reserve starts raising rates, when productivity is this low, they're kind of locking in, if you will, low productivity and therefore lower long rates for a long period of time. So to think that we're actually going to have a Phillips curve wage increase push with productivity this low at 1% is not the best story for the U.S. And if you go to the next slide, I think one example of this is look at this measure of the ease of doing business index. You can see there on slide 10 that in 2007 the United States ranked 7th globally, and now in 2015 we've declined quite a bit, and now we're ranked 13th. And so, this is an important measure, right? It's starting a business. How easy is it to get construction permits? How easy is it to get credit? What's the tax regime that you have, et cetera, et cetera. Those are the measures that go into this. And while financial regulation, in many ways has been a positive in protecting, the banking industry, just some of these subtle things as far as, ease to do business have really been a drag on productivity, and in our view, not something that is going to reverse anytime soon. So very concerning. Then on page 11, just some more thoughts about rates. Just very quickly, I would say, why do we still think we can get to 2.5%, over the year, despite all the volatility and the somewhat dark scenario I just pointed, at you? Really is that we do expect year-over-year CPI to actually be 1.5%. So the Fed will at least feel like they're making some progress on their inflation target. And we do think that really all of this weakness we're seeing in terms of credit is a first quarter phenomena. And even now, something we're watching very carefully, if you look on the upper right-hand side, we have industrial metals and factory commodity prices. It appears, despite all the negative rhetoric around China and everything, that we may be going through a bottoming phase. So very important to be looking for these types of signs, just given the emotions in the market. But we're watching it very carefully and saying it looks like we're almost at our worst inflection point, and that it should get better from here. So with that, what I'd like to do before opening it up to any questions is to now pivot to the spread market. And what does all this mean for the spread market and the spread view? And, as you see, Voya Investment Management has a pretty bleak first quarter growth outlook. We've seen growth slowing for some time. And so we as an organization, in some of our multi-sector funds that we manage, we own, where we're able to, we own no EMD debt and only 3% high-yield debt, double Bs. I mean, for a kind of a multi-sector bond portfolio, we're quite defensive and have been, I think, when you look at rankings from eVestment and things for last year, more defensive than many of our counterparts out in the industry. So now what do we do? Because we're sitting at this inflection point where our view is kind of realized, right? Because we are negative and talking heads in the market are like, oh, what's the percent of recession? You didn't really hear the R word, recession, much at all out of CNBC, 4 months ago. And now we're our view has gotten kind of priced into the market. So what do you do? And are we going to actually start increasing our spread exposure? So what I want you to do is just go to the next page onto slide 12. And this is a chart of high-yield spreads. And what's happening right now is that a lot of bad news is actually priced into spreads. And I want to talk a little bit about this and tell you exactly what we're thinking and what we're doing in terms of spreads and our spread outlook. This is just high-yield OASs, and you can see the gray bars there are recessions, and then the blue line are current spreads. And you can see essentially that the high-yield index gets where it is during times of recession. So what you have to think about is, okay, recession is already priced into these sectors. Do I believe that a recession is going to occur, yes or no? But the other thing that's interesting is you could also say, well, is the high-yield market predicting a recession? Potentially. It doesn't mean that a recession has to occur because you see periods of time where high-yield spreads have gone above that line and it's been gray. But again, the high-yield market is sending a pretty negative sign, but that also means that it's priced in quite a bit of negative news. So if Voya Investment Management's view is that we're still going to have year-over-year positive GDP growth, we're not predicting a recession, and therefore we are being compensated at this point to take on this type of risk. And if you move to the next slide, this is just another way to think about it, and because so much of what's going in, say, the spread sector like high yield is energy related. Is it Chesapeake? Is it Arch Coal? That type of thing, right? And so what we did and what we thought about is this line really goes back through time on slide 13 and looks at, U.S. high yield in two different ways. There was a bad high yield market in the 2000s, and it was all telecom related. If you can remember just kind of the craze that went about with IPOs and telecoms. And what we did is we started to think, well, how is that versus, the high-yield market today where the distressed sector is metals and mining and energy. And so really what these different charts kind of lines go through is we look at U.S. high-yield X energy, what's that spread, and X metals and mining. And then what was U.S. high-yield, that orange line, going back in time, X communications. And so really what you see here is that our market is equally distressed as that time in the market. And what we think of as like core. So take out the bad stuff. is the rest of the core franchise, priced at similar levels. And you can see the global financial crisis, which nobody out there is talking about us being in one of those just yet or anytime soon. You can see really that the high yield index has gone up to those levels today. And then again, another way, if you go on to slide 14 to think about high yield, is what is the implied probability of default? Not necessarily the best measure in the world, but certainly something a lot of people in the industry do look at. Do we think this is going to be another crisis flare-up? You can see here the implied probabilities of default are really near their historical peaks, again, excluding the global financial crisis. And so we need to kind of ponder, is the energy complex, enough to really create such a growth phenomena in the U.S. That this is going to be a significant problem. So, again, asset prices are pricing in a lot, and I want to talk a little bit about how is it different this time. So I want to just have you move to one more page, and the last one there is titled U.S. BBB spreads. And again, if you look there, just another way to look at what's priced into the market, and this is something Morgan Stanley put together. Current BBB spreads are there at the bottom, and you can see, again, we are really pricing in a recession. And here, the tagline here is that the average spread for BBB rated U.S. corporate bonds, over all of these multiple recessions, and so you can see that we're right out there, outside of 1929 and sort of that subsequent recession, and then of course the global financial crisis. So again, credit markets are pricing in a lot of negative news. Now, when you think about allocating risk, what do you want to think about though? Is that how the high yield market is different from the early 2000s is that back then, when you think about U.S. nominal GDP and the potential of U.S. nominal GDP, we were much higher there. And today I told you about secular stagnation. I painted a pretty dark picture as far as long-run interest rates for the U.S. And so, if the U.S. really can only grow at 2 to 2.5% given all these challenges versus 4.5% before, we have to be very careful looking at history when it comes to high-yield companies because these things are levered, and what they rely on is they rely on nominal growth in order to make their business models work. We at Voya, I think there are some select opportunities within the below investment grade market and credit, but to be careful, on a risk-adjusted, given that dark view, I would say high yield is cheap when we regress it and think about is high yield cheap to BBBs or to IG credit? Yes, but just go in with your eyes open knowing that things are a little bit different than looking at these past charts and to be a little bit more careful. Therefore, sticking with BBBs may be a better decision for you. But I would say also, what we're thinking is we're still not quite convinced that the markets have fully priced in the weakness that we're going to see in Q1. So we as an investment manager are starting to add risk in more liquid ways right now, not yet in high yield, but in some other sectors. So for all of us as investors, you always have to think, has my view of the economy changed, yes or no? I mean, if we're expecting a recession, if the right thing to do would be to still stay very, very conservative. That's not our view. And has our view been priced into asset spreads? And I've pointed out to you that recession is now pretty much priced into spread sectors of the market. Therefore, it is tactically time to be adding some risk into your portfolios. So if you go then onto page 16, our conclusions are interest rates, we are neutral interest rates right now. We had been long, and we had been long what we call 5 years, like more of a flattening trade. We have now moved to neutral, and why? Because the market, even though we're darker than most, the market is only pricing in one Fed move, and given our view of improvements in inflation and a stronger second half, we think we'll get, we had predicted 3, maybe that's now 2. And then secondly, expect a steeper yield curve. The Fed will slow down. The market is too pessimistic on inflation, so long rates will go up. Tips break-evens look very, very attractive actually right now. And then in spreads, again, first quarter, we do expect one more leg of volatility or widening in spreads. One thing we do here at Voya is quite a bit of equity hedging, and the VIX as a measure of distress in equities is not where it was in October of last year, so it's potential that we may still see more growth disappointments given our view and a little bit more equity volatility. So I would expect one more leg of potential widening in spreads. But again, given our view of GDP, that we're not entering recession despite all of the challenges of China and everything else, we look for this to be the trough in growth and to increase risk given valuations. So that's what we're thinking about. Certainly, I think along all of these things, we can have a great debate with Mr. Skinner as we have our forecasting dinner in just another few weeks. But hopefully in the context, I've given you some insight into at least what one of the people in the survey was thinking about. And certainly, there's a broad range of views out there by the people that submitted in the CFA charter, including one very interesting negative rates, which is not preposterous at all, given what's going on. So, would love to have an active questioning and dialogue at the dinner, but certainly am very happy to answer any questions or challenges to our view or ideas on your own view that you might be willing to share. So what I'd like to do now is ask the operator to go ahead and open up the line to see if any of you have some questions. So operator, if you would, let's go ahead and turn it over to our callers and see if anybody has some questions.
Thank you. At this time, if you would like to ask a question, please press star 1 on your telephone keypad. Again, for questions, press star 1 now. Once again, if you would like to ask a question, please press star 1 on your telephone keypad. And there are no questions at this time.
Okay. All right. Well, I know I threw a lot out at you in terms of how we approach things. I will be at the dinner, so to the degree that you're there and want to get more clarification or debate, I'd be happy to. But again, I really look forward to a great debate. It's obviously already a very interesting year. Is the U.S. going to fall into recession, yes or no? I think can't wait to see what our speaker has to say about all of that. So I really appreciate you dialing in and enjoy getting a chance to interact with all of you at our forecasting dinner. So thank you so very much.
Thank you for your participation in today's Voya's 2016 Outlook for Interest Rates and Spreads conference call. You may now disconnect.